This document outlines key principles of investing and saving, focusing on segregated funds and annuities. It also compares these products with other investment types such as stocks, bonds, mutual funds, and ETFs. Investment and savings principles. The concept of investing. Investing starts when an individual has savings or the ability to set aside money from their income. There are several time-tested methods to encourage saving, including pay yourself first. Treat savings as a budget expense to reduce the temptation to spend. A pre-authorized contribution, PAC, or pre-authorized deposit pad is a highly effective way to build savings. Save 10% of take-home pay. The percentage may be adjusted based on individual circumstances. Save exceptional payments. Put aside money from sources like income tax refunds or work bonuses. Set up savings buckets. Assign a dedicated purpose to savings, such as for retirement, holidays, or a car. Investing is the process of using savings to purchase products with the goal of making a profit. The initial sum invested is called the principal or capital, and the profit earned is called the return. Investment basics. Compounding. This is a powerful tool where interest is earned on both the principal and previously earned interest, leading to escalated growth. Compounding is most effective over a long period, which is why advisors recommend starting to save early. However, costs and debt can also compound. Returns. An investment's return can be positive, a profit, neutral, recovering the initial amount plus any fees, or negative, a loss. The return is often expressed as a percentage, known as the rate of return. Risky investments have an unpredictable return. Risk. The scale of risk ranges from very low risk to speculative risk. Speculative investments are the riskiest, with a high chance of a negative return, but also the possibility of very high positive returns. This relationship is known as the risk/return theory. Diversification. This is a strategy that combines different asset classes and investments to spread out risk. Pooled investments, like segregated funds, automatically provide diversification. It is difficult for an individual investor with limited capital to achieve adequate diversification on their own. Liquidity. This describes how quickly an investment can be converted to cash at or near its market price. A savings account is a liquid investment, while real estate is often illiquid. Liquidity is crucial for emergency funds. Time value of money. This principle is based on the potential for invested money to increase in value over time due to interest. It has two aspects. Present value, PV. This works backward from a future goal to determine how much needs to be saved today. The formula is PV equals FV/1 plus interest rate, N. Future value, FV. This calculates how much a sum invested today will be worth in the future. The formula is FV equals PV times 1 plus interest rate, N. Investment objectives. Investment objectives are the reasons for investing and can be classified as short-term, 3 years or less, medium-term, 3 to 10 years, or long-term, 10 years or more. Examples include saving for a holiday, short-term, or retirement, long-term. Tax-advantaged investing. Investment returns are taxed differently depending on if they are interest, dividends, or capital gains. Interest. Taxed at the highest rate, the same as income from working. Foreign dividends are taxed as interest. Dividends may benefit from the dividend tax credit, which taxes them at a lower rate than interest. Capital gains. When a capital property is sold for more than its cost, only 50% of the gain is taxed at the investor's marginal rate, making it the lowest tax rate for investment returns. Capital losses can be deducted from capital gains. Types of investments. Segregated funds. A segregated fund is an individual variable insurance contract, IVIC, created and sold by life insurance companies. They are kept separate from the insurer's other assets and provide guarantees to investors. Segregated funds are considered less risky than mutual funds because of their guarantees. In the event of the policy owner's death, the proceeds bypass probate, which can save on estate fees. Advantages. Maturity and death benefit guarantees. Potential for creditor protection. Ability to designate a beneficiary bypassing probate. Tax benefits from capital losses. Investor protection through assurees. Disadvantages. A minimum 10-year term is required for the maturity guarantee to apply. Often have higher fees, management expense ratio or MER, than mutual funds. Possible age restrictions on deposits. Returns and guarantees. The return is based on the fund's performance minus fees. Investors have a maturity guarantee, which ensures they will receive a minimum of 75% of their invested sum at the contract's maturity. There is also a death benefit guarantee, which ensures the beneficiary receives a minimum of 75% of the invested sum if the life insured dies during the contract term. Annuities. An annuity provides a reliable stream of payments over a period of time, which are a combination of the investor's principal and interest paid by the insurer. They are highly secure and protected by assurees. Advantages: steady income stream. No need for investment decisions or performance monitoring. Protection through assurees. Disadvantages: lack of flexibility as changes cannot be made to the contract. Interest rate risk, as payments are based on the initial rate and do not increase if rates rise. Penalties for early withdrawal or surrender. Loss of principal if the annuitant dies before all capital has been paid out. Stocks. An investor who buys stock is buying ownership in a company. The value of the stock can rise or fall based on the company's fortunes. Stocks can be common or preferred. Advantages: opportunity for significant price gains with no ceiling. High transparency in pricing. Potential to receive dividends. Favorable tax rates for capital gains and losses. Disadvantages: possibility of total loss of principal. Lack of diversification in a portfolio of individual stocks. Commissions charged on every trade. No protection against market price declines from investor protection funds like CIPF. Bonds. Bonds are a debt investment where the investor is lending money to a bond issuer, such as a government or corporation. Bonds have a fixed maturity date when the principal is repaid and typically pay regular interest payments, the coupon rate. Advantages: can provide a predictable income stream. Government bonds have guaranteed repayment of principal and interest. They can be sold in a secondary market before maturity. Disadvantages: lack of transparency in the buying process, which can lead to overpaying. Lower returns compared to higher risk investments. Corporate bonds have a greater risk of default than government bonds. Mutual funds. Mutual funds are pooled investments where money from multiple investors is managed by a mutual fund company. They are a popular alternative to GICs for those seeking greater growth potential. Advantages: wide variety of funds available. Professional management and diversification. Availability for registered and non-registered accounts. Disadvantages: not intended for short-term investment. No guarantees against losses. Fees such as the management expense ratio (MER), trading expense ratio (TER), and sales charges can erode returns. Exchange-traded funds, ETFs. ETFs are pooled investment funds that issue shares and are traded on a stock exchange. They are known for lower fees compared to mutual funds and segregated funds. Advantages: diversification and ease of trading like stocks. High transparency with daily disclosure of holdings. Lower MER and no sales load. Disadvantages: commissions are usually charged on buy and sell orders. Can have low liquidity if not frequently traded. No guarantees and returns may not exactly mirror the underlying index. Risks of investing. Economic risk. The possibility of an investment being affected by macroeconomic factors like changes in government regulation, political upheaval, or a pandemic. This risk cannot be managed by an individual investor. Equity risk. The risk of loss because the price of a stock falls. Inflation risk. The risk that the rate of return on an investment is lower than the rate of inflation, leading to a loss of purchasing power. This is particularly serious for long-term, low-return investments. Interest rate risk. The risk that an investment is locked in at a low interest rate, and the investor cannot take advantage of rising rates. This risk is inherent in investments that pay fixed interest rates, such as GICs, bonds, and annuities. Market risk. The risk that the entire financial market will decline due to uncontrollable events like a recession or natural disaster. Diversification does not protect against this risk. Liquidity risk. The risk that an investment cannot be quickly and easily converted to cash. Real estate and some annuities have high liquidity risk. Foreign exchange risk, currency risk, the risk of a change in the price of one currency against another, which affects returns on foreign investments. Credit risk, default risk, the risk that a borrower will fail to repay a loan or other financial obligation. This is highly relevant for corporate bond issuers. The risk is low for high credit quality borrowers like the Government of Canada and high for low-rated bonds. Industry risk, the risk faced by specific industries due to factors like consumer indifference or supply chain disruptions.